The week of June 14th has been, well, it's been the worst week since January. And one of the things that people are talking about is what is causing this. Is it the Fed? Is it the Fed's hawkish approach to possibly raising interest rates in the very near term? Now, as a review, on Friday, we saw a humongous drop in the Dow Jones, a 1.58% drop in overall, or 533 points. That's pretty sizable. I think that's last time that happened was in October of 2020. The S&P 500 dropped 1.31%, or 55 points, and the NASDAQ dropped 0.92%, or 130 points. The NASDAQ didn't take as much of a beating from a percentage-wise compared to the S&P and the Dow Jones. We also saw just a butt-whooping when it came to the CRB index, which is the commodity index, along with a handful of other indexes. And the question is, this drastic move, what is causing this? Is it the Fed's language during its Fed's meeting on Wednesday? Is it their hawkish approach to possibly raising interest rates? Before I get going, please hit the subscribe button. And if you like this video, hit the like button and share it with a friend. Also, always, this is just purely educational. None of this is advice. Here's the thing about all this, and I think the story has been being told for a while, actually since probably May 17th of this year. The bond market has been showing signs that it is, well, showing signs that the stock market, the equity markets, the Dow, the S&P, are showing signs of a bearish tone. And if you go back and look at the yields on the 10-year Treasury, we have seen them drop from a 1.7% range back down below 1.5%. What that means to you and I is that bond values have started to go up. People are buying more bonds as protection. What that means is when yields go up, it means people are selling out of bonds, so they're more bullish, versus yields going down, bond yields going down, and you see a more bearish tone to the market. People are buying bonds as protection. Well, this has been going on for, well, over a month now. And yesterday we saw the biggest move in the S&P, the Dow, the NASDAQ in, well, almost 5-6 months. The Fed at its meeting stated that they were thinking more about raising Fed funds rate. I believe it was 2023 was their target. Well, that's a long ways away, in my opinion, but what the bond market is telling you is that the economy is starting to slow, that the inflation trade is actually starting to deflate. So one of the biggest movers of markets is the US dollar. If you track the US dollar, you have noticed that it has gone from a low of 89 cents on the dollar to, as of yesterday, roughly 92 cents on the dollar. Well, what that means to you and I is when dollar rises, the cost of goods actually starts to deflate. So go look at lumber, go look at copper, go look at corn, those kind of commodities. And what you're going to see is those values have started to come off their highs, which started, well, back a couple weeks ago. So as we watch the dollar value up and go up in value, we're going to start to see these trades in the commodity market that started back in June of 2020 start to turn around. We're already seeing that in specific areas. So actually, this is great if you're looking at building a home anytime soon, because lumber costs are going to actually go down because the dollar is rising. Your money is now buying more. And the question I have is, why are people buying more dollars? Why is the dollar value going up? I mean, of course, it's about supply demand. It's about people wanting more US dollars. Is it the world saying, you know what? We're taking a bullish tone on the dollar. We need dollars. We're going to start to deleverage our risk overall. Last week you saw China start to unload a big chunk of their copper positions. And that had a big effect on copper. And it'll be interesting to see what happens over the next couple of days or over the weekend and into next week. Will we see a continuation of that copper sell-off and other commodity sell-offs? Take a look at the CRB index. This is the whole commodity index. This gives you an idea of what people are looking at when it comes to commodity values, and in relation to the US dollar, it's a very opposite correlation. And if you start to watch the dollar and you watch the bond yield movements, like the 10-year or the 2-year, I mean, go back and look at a 2-year Treasury note. The yield on it, or the bond, the yield on it jumped. I mean, people are moving out of that into actually longer term bonds for more protection. For the last couple months, the macro play really hasn't been the thing. It's just been heavy, equities, heavy, high risk, high beta positions. And the macro thesis hasn't really played out. Well, until recently. And the macro thesis really is based on the US dollar. And when you look at the US dollar and how it's used on a global scale, well, it is the currency of the world. I believe 95 to 98% of all transactions throughout the world are done in US dollars. So because the macro thesis has come back into play, you got to start watching what moves global macroeconomics. And that's primarily the US dollar. And we have seen that effect over the last couple days. When the dollar moves, markets move. So this really brings into question, where is the economy going the second half of 2021? Well, if the dollar starts moving higher and it has an opposite effect on commodities and commodity prices start to come down and price of goods start to come down, I believe this is going to be a slowing of in the second half of 2021. So how do you position your portfolio for this? If we are really going to see a slowdown, if the continuation of the US dollar rising, commodity prices coming down, there's not a lot of play in the bond market, but there is protection there. I believe you're going to start to see equities in certain categories start to sell off. In other categories, you're going to see them rise. In particular, technology. We saw the technology effect after COVID hit back in March of 2020. Technology took off, and then it subsided over the last 6 or so months. Not as much of a return. Well, I believe that's going to come back into play. So looking at technology, looking at the 10-year Treasury or high-grade bonds, not so much high yield anymore. High yield's had a great play, but in the last, 3 or 4 months, but it's going to be more higher grade bonds that are going to do better in a slowing market environment. As you can tell, I'm still in Crested Butte, Colorado, and as I'm doing this video, my microphone sound went off. So hopefully the sound is still good on this video and you're hearing what I'm saying. The point of what I'm saying in the end is this. As long as the US dollar continues to rise, you're going to see volatility in the equity markets. And where it's going to actually work out in your favor is more in the bond market, along with the technology sector. So start looking at reallocating your portfolios to benefit from a slowing overall economy. So in conclusion, here are your key indicators. 1, the dollar continues to rise above this 92 cents on the dollar level. Number 3, the euro falls below 114 and down towards 110. Big indicator the stock market's about to puke on itself. And 3, the commodities market continues to fall. These are great indicators for you to make portfolio allocation decisions when it comes to your stock portfolio and looking at assets like high-grade bonds and tech-type stocks. because those are things that most likely will perform well as we see the stock market and the U.S. economy starting to slow down. So in the meantime, have a great day, live loud, and I hope you're doing well.